Hi, and welcome back to All Things Money. I'm your stand-in host, John Gjertsen, filling in for David Blain. I've been talking about 529 plans, what's good about them, what's not so good about them. I'd like to just finish up on the point I was making in the last segment. I'm not big on 529 plans, at least as far as trying to make sure that every college dollar is funded inside a 529 plan. The biggest reason being I don't want people to shortchange their own retirement planning, and that's something that people, you just read surveys. In general, the American population has done a very pitiful job preparing for retirement. So I want people to realize that that is the bigger goal. Children can work, they can take out loans, they have all sorts of human capital to apply to the problem of college funding. But in retirement, you need to have financial capital built up for that. So I don't want people to be shortchanging their retirement just for the sake of college funding. But the other thing about funding 529s is if they're overfunded, well, you run into the problem that people don't need to spend their 529s because they get a scholarship, because they get a grant, because they don't end up going to college, or for whatever reason, people don't need these things, and then the parent is able to change the beneficiary, as I mentioned before, to a sibling or to a cousin or something, but they, there may not be another sibling left over, and at some point you may, as a parent, have to basically take the money out of the plan and not have it be a qualified educational thing, and there's penalty for that. You're taxed on the gain that you made in the plan. So if you've put in, $50,000 into the plan and then you've made $16,000, then you're taxed on that $16,000. You're also penalized 10% on the earnings in that plan. So that tax and penalty, the penalty especially, kind of mitigates, if not eliminates, some of the most of the benefit of having that money grow tax-free to begin with. So certainly if there's any perceived risk that you would not end up needing this money for education, then it's an unwise decision to really load these things up. So it's also unwise to assume that college is going to, the prices of college expenses are going to be astronomical, and just to put in tons and tons of money into these things, if in fact the college costs that you incur are more reasonable than you thought. So I guess it's sort of a way to supplement college savings and not the whole name of the game. And the other thing that is a little bit of a problem and some consideration, certainly, as you look at 529 plans and other college savings plans, when a child applies for financial aid on the FAFSA, F-A-F-S-A form, these assets, if they're set up by the parent, are counted as assets of the parent and looked at in terms of what they can provide. If it's set up by a grandparent, it actually shows up usually as the asset of the child, which is even worse in terms of the FAFSA. So, by comparison, if you have a Roth IRA and you are able to, and that's a retirement asset for the parent, that's not counted. Because it's a retirement asset, that's not counted, even though the contributions to that Roth could be withdrawn without tax or penalty to pay for education if they need to. So, but if they don't, if that's sort of the college savings plan, could be some of your own retirement money as a backup, and then it could actually increase the chances of qualifying for financial aid. So that's some of the nuances of why this might work out better not to use a 529. Well, the last thing I really wanted to talk about was how creatively wealthy people are at avoiding taxes. And as it's come up before in this program, the people that stand to gain the most from gaming the tax code are the wealthy. And so it should not surprise us at all to see how wealthy people have taken a look at the law and used it to their advantage. And I salute them for finding creative ways to avoid tax. It's a lot of fun. So the 529 plan, though it was probably not intended for this purpose, is actually a tool in the arsenal of the very high net worth who are subject to estate tax. If you may or may not be aware, we have basically an inheritance tax where $5 million or slightly more than that is about all that you can pass on to an heir. You have twice that as a married couple, but you know, for the very, very affluent, if you have, you know, $30, $50 million in your estate, then a good chunk of that is going to be subject to a very, very hefty inheritance tax to the tune of about 45, 50% of the assets that is estate taxable. So it is entirely the name of the game for the very high net worth is to not die with a whole lot of money. So there's all sorts of strategies of gifting, of getting assets out of the estate. And as I mentioned before, the 529 plan is it retains a character of as though it's an asset of the person who is setting it up, in that they get to make investment decisions and that they can change beneficiaries. It in many ways looks like a kind of a grantor trust, in the sense that the person setting it up still retains control. And so usually in a case where, like in a grantor trust case, the person setting it up would not be a completed gift. Setting up, putting money into that trust, that's not a completed gift until it gets out of the trust and into the hands of the beneficiary, because there's that control that's kept. So, but with a 529 plan, it is not counted as a estate tax. So you can give up to the limit is $14,000 in 2013. Married couples, of course, can double that, $28,000. With the 529 plans, you can actually pre-gift 5 years worth or $140,000 for a married couple to each grandchild. They can get that out of their estate and free from estate tax. Now, of course, the 5-year that gets prorated back. If they die within that 5 years, then the certain portion of it that applied to their what would have been an after death gift that comes back into their estate. But they can get rid of substantial amounts of money using the 529 plan, and as a side benefit, they can actually fund their grandchildren's college education. But it's a tremendously efficient way of the ultra affluent getting money out of the estate. That's all the time we have on All Things Money. We'll see you next time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.